Steve, this is a quote from Kevin Warsh, one of the Fed governors, a speech he gave this week. Government should outline and defend a positive vision for financial firms and welcome back private capital's return. Some are reading that as the Fed, having been scrutinized by Congress in recent weeks, pushing back, saying, if you want our stuff to work, you guys have to lay off the language, right? Lay off the anger.
Well, there is something to that. And also, though, I hope he's referring to this whole mark-to-market controversy. As you know, FASB, Financial Accounting Standards Board, made a few changes, but not nearly enough. They're not going to allow the banks to write up the assets, some of those toxic assets, which were knocked down too much. If you do a cash flow analysis, those toxic assets still probably worth 50 to 60 cents on the dollar, not 10 or 20 cents. So let's get more realistic valuations. And so banks don't have to worry about the big black hole out there, nor do life insurers in terms of their balance sheets. And then they can start lending again.
So what Bernanke and Geithner and company did was to put this plan out to get the toxic assets off the balance sheets. By the way, you know, as a free market guy, you should like the idea of this program, because that's good. If these assets are undervalued, we're now going to have a market for the assets, and we're going to find out what these private investors are willing to bid for them. I actually think they're probably overvalued a little bit in some cases, but let's find out. There's now a market for this stuff as soon as we get these partnerships up and ready. But the most important thing is when you take the toxic assets off and put them in the private sector with these investors, then the banks have no excuse for not rolling over the credit of the small business people who are being driven out of business for no particular reason.
One of the key reasons why the banking system, even though it has more cash than it's ever had before, is in a state of semi-paralysis still today, is because of uncertainty about how much capital it really has. And when the regulators started to mark down because of this crazy mark-to-market rule to unrealistic levels, banks aren't going to make those kind of loans. And that's why it's very hard to roll over a loan. You pay more, you pay 2,000 points above LIBOR and stuff like that.
Right.
And
so I disagree with you on mark-to-market, too.
Mark-to-market has been a disaster.
I don't think so.
If we'd had that in the early 1990s, when we last had a banking crisis, we'd have destroyed most of the major commercial banks in the country.
See, I think mark-to-market is there for a good reason. It gives us some transparency. You can't hold assets and put them at whatever
regulatory
value you
capital,
want.
Governor. Regulatory capital is supposed to be long-term capital. What would the value of your house be if you had to sell in the next 10 minutes? That's what mark-to-market did to the capital of banks and insurance companies.
I don't disagree with having modified the mark-to-market rules, but I think you have to know what the market for your asset is and the way that the government.
Well, that's fine, but put it in a footnote. As Alan Greenspan, he got this right 18 years ago at the SEC. He said that's wonderful information, but don't flow it through the balance sheet.
The point you're both making is the same, and that is when the rules change, it's impossible to invest, right? It's impossible to play markets where, whether you agree with the governor or yourself, there needs to be consistency. Governor, the stress tests, if we do in fact get some meeting about it tomorrow, as some are reporting, and if it's true that all of them are going to pass, does that test have any credibility with you?
I think it probably does. Look, I don't fully understand exactly what they're doing with the stress test, but any kind of way that you can measure performance, there's some banks that are worse than others, and it's going to be interesting to find out. At some point, some of these banks are going to be taken apart and dismantled, and it's important to pick the right ones if you're going to dismantle them.
Then why is the government saying everybody's going to pass this stress test? What's the point?
I don't know, because I don't know what's in the stress test exactly. But if they're all going to pass the stress test, maybe none of them are as in bad shape as we think they are.
Well, precisely, and that's the whole thing on the mark-to-market. If we didn't have that kind of crazy system, right now the banks today, as you know, have twice as much cash on their balance sheets than they did 6 months ago. They are brimming, and on an operating basis, they are making more money than ever before. But because of the crazy regulators and auditors, fearful of lawsuits, are doing this thing, we still have a constipated credit system.
Well, Steve, let me ask you a question about mark-to-market. If you got rid of mark-to-market, how would you prevent banks from falsely inflating their assets and essentially falsely deflating deflating the amount of leverage they have?
Well, if it's a regulatory capital, you wouldn't have what you had in the 90s and early part of this decade, where capital is artificially increased thanks to mark-to-market, and then in a downturn artificially decreased. You want capital to be steady, long-term. If you're buying a 10-year bond, for a 10-year liability, don't have it fluctuate day to day. It's a long-term liability. Regulatory capital should be stable in value. And if there's a loan's impaired or an asset's actually impaired, then you write it down. It worked for 70 years after the Great Depression. We got rid of mark-to-market back in 1938 for a good reason.